Awesome. So yeah, just by way of quick introduction, again, co-founder at Cirrus Capital Partners. Previous to Cirrus Capital Partners, I've been a founder myself. Founded three companies to date, raised both equity and credit for those companies. And additionally, through my work over about the past 12 years or so in the private credit landscape, have had the opportunity to help transact on about 700 million in career financings, largely to small businesses, startups, scale ups, and lower middle market companies looking to invest into growth and avoid dilution while doing so. So that's my quick intro. Uh, my portion of the presentation today, I really just wanted to give everyone kind of a state of the market specific to equity fundraising. And the reason I wanted to focus on this is because one big similarity that brings the relationship between Cirrus Capital Partners and Founders First together is the fact that we are very focused on growth focused companies, um, often in the vast majority of cases, either true SaaS or tech enabled services or tech adjacent businesses. And these are also companies that generally lend themselves to environments where they're out raising equity capital as well. And so we're frequently in conversations where companies either do have great investors on the cap table to date, or perhaps they're in between rounds or looking at what that looks like in a near or midterm future setting, and helping them navigate between kind of a use case of proceeds between equity and credit and so forth. So let's kind of see what's going on in the equity landscape. Things have been interesting the last couple of years, and I don't know if anyone on this webinar can kind of relate, but I recall back in 2020 and back in 2021, numerous companies that I've had connectivity into, were raising capital at some pretty favorable valuations, right? 20x, 50x, 100x multiples on revenue. It seemed fairly, I wouldn't call it easy, but the process was fairly simple to go out and start to put together a process for either a priced round like a Series A or B financing, or gain line of sight into closing on a safe note or a convertible round or so forth. What we've seen since then, and I think I'm no pundit, so take all of this with a grain of salt and use your best efforts to predicate your viewpoints. But I think we're seeing a bit of a leveling out, but we're still kind of in this awkward trough where it's difficult to go out and raise equity capital. And this first chart I wanted to show everyone, this is startup fundraising by both volume and by dollar amounts and total cash raised. And so if you look at 2024 for Q1, from a total deal count, it's far below what it has been in recent years. And from a total dollars raised standpoint, it's sitting about flat, a little bit of a lift where we were at in 2023, but certainly not where we were at in 21 and 22. This data that we're looking at here is agnostic of industry. And so take that with a grain of salt. Obviously, if you look at 2024, you may find that a lot of these financings are kind of upholded by AI startups and so forth. But if you get down to each specific kind of subcategory or industry, there's some interesting findings in there. By the way, huge shout out to Carta. Encourage everyone to check them out. This is, I have no professional affiliation with them, but they're just great in the way that they present this type of data, and just a great company to follow in general. Here's another interesting statistic that basically portrays the valuation when companies are going to raise equity financing is down as well. So if you compare this to, again, kind of I suppose I'll call them like the glory days of 2020, 2021, where well over 90% of founding teams were raising their next rounds on an up round or an increased valuation of the company. We're not seeing that anymore. It is still the majority of companies that are raising capital at more favorable terms than they had previously. But ultimately, only 3 and 4 rounds that are raising at an up round, which means a fourth of those rounds are on a down round to simply get more capital into the company, but not quite on favorable terms or as favorable terms as they had been historically. We can also see that the share of bridge rounds has never been higher than of recently in the year 2024 and 2023. So, what does this tell us? What it tells me is that I think coming out of the last few years, one, we've seen a behavioral shift with companies. I think, you had a lot of confidence in the last few years, or a few years ago, rather, in going out and raising equity rounds and doing so at favorable terms and having that nice PR release that said, hey, we're doing great. We just went out and raised 10, 15, $20 million for our company. Here's the press release. Now what I think we're finding is a lot of companies are doing a bit of soul searching and discovering, hey, maybe we want to gravitate a little bit away from the growth at all costs kind of philosophy and look at how we're going to reach profitability more quickly, look at ways that we can put forth cost reduction strategies and ultimately run leaner businesses because of that. And I think that's one thing that's impacting why companies are going out and raising kind of these smaller incremental rounds is because maybe there isn't the need or the interest in going and raising a larger price round, especially if valuations are suffering accordingly. And so those big kind of 10, 15, $20 million plus fundraisings might be taking a back seat to a more simpler equity fundraise process, where they might be going and putting together 500,000 or 1 million and $2 million. And then generally, if we look at kind of this same subset, 2020 to 2024, we see that the current kind of state of the market right now looks a lot more similar to 2020 than it had previously, in the way of the size of these financings. I do want to call special attention to the fact that this is only focused on safes and convertible notes, largely because if you're going out and raising equity, and you're raising something within the kind of 250 to $1 million range, oftentimes they're going to be structured, more akin to that structure and not necessarily a price round. But nonetheless, we're seeing a lot of financings that are below the $1 million mark, relative to 21 and 22 again, where there were about a quarter or above percent of financings that were above 1 million and upwards of maybe 5 million. And then I'll show you a slide here that has just kind of always been the case. And the thing I want to call out here is VC money often makes its way to a few states in particular. Kind of no surprise here to many, I'm sure, California being the biggest, New York falling secondary to that, and ultimately, Massachusetts, Boston, you have a lot of Harvard alum, following closely behind New York and New Jersey. So all of these things kind of put together lend themselves to an environment where, again, behavioral shifts are taking place, both from an equity investor's perspective and from a company or a founder's perspective. And I think the questions that founding teams are asking themselves, as I alluded to previously, are, do we need to go out and raise equity? What are we using this capital for? How fast do we want to grow? Sure, we could probably go out and triple revenue this year, but do we want to do so at the expense of burning hundreds of thousands of dollars a month? Or do we want to grow a little bit more gradually, be really methodical about R&D and the products that they're releasing into the market, and have a very sustainable business at the end of the day? And a lot of these behavioral shifts have been good for the credit space, and specifically within private credit, growth debt, venture debt. Depending on the definition, depends on whether you're looking at kind of the true definition or the historical definition of a venture debt investor getting really excited about equity and cash position and liquidity in a company versus those who might be a credit investor and just taking a bit more equity level risk, but helping you avoid dilution in the process as well. And so within that way of thinking, what we're currently seeing at Cirrus Capital Partners, and I'm sure that Founders First could share the same, is we're seeing a lot of founders they're saying, hey, we're not looking to triple, quadruple the business this year. We're approaching or are marginally profitable, or perhaps very profitable, depending on the company. They don't want to change that anytime soon. And they either have cash flows or growing revenue or assets that they can use to leverage towards a favorable credit decision. And the comparison there often becomes, do I want to pay kind of a fair and respectable cost of capital for a credit instrument versus what could be in the instance of a liquidity event in the future when you go to sell your company or IPO or have private equity buy-in with majority ownership, a pretty sizable cost of capital had you pursued equity instead of credit. And so I won't get into all of these. I know that Oscar is going to share a lot of really cool stuff about what they can do in particular, and Founders First is great in the respect that they can offer multiple structures and types of credit to businesses that actually meet almost all of these. But ultimately, the main thing I want to hit home is that there are a lot of ways to inject very responsible capital into a business that can best support that initiative to grow, but do so very sustainably, predictably, and at the end of the day, have a stronger and more predictable business in the long term. So, that's my long-winded kind of state of the market there. I'll kind of pass things over to Oscar, and happy to field any questions here closer to the end.
Perfect. Thank you, Ryan. Thank you so much. I was actually taking notes in here. And just correct me if I'm wrong, but I was looking over the slides. 72% of the pre-priced rounds were less than 1 million, right? Yeah.
That's right. Yeah, in
Yeah.
fact, it's I think if you add those two together, I think you're probably spot on. Yeah.
Yeah.
So that's, and again, like it's very easy. I'm on LinkedIn all the time, and it's super simple to get carried away with really big headlines. And it
Yeah.
seems like everyone around you is out raising just huge rounds and growing 100% or 1,000% year over year, right? That the reality is most companies are looking for a 500,000 or 1 million or 2 million to best support them in kind of the seed and early stage part of their business. And if you look at what it takes to get there, and this isn't me bashing on equity, I think within most companies you could find very valid use cases for both credit and for equity, and kind of
100%.
bifurcate how you're going to use those funds appropriately. But key takeaway here is, yeah, most companies are out there
Yeah.
looking for
No, and the
smaller.
100%. And the only reason why I wanted to bring it up, and by the way, this is a perfect segue to what I want to get into. The only reason why I'm bringing it up is because you're absolutely right, right? So a lot of the companies that we work here at Founders First are the ones that are looking for funds close to that range, right? Whether it's 400, 500, 600, 700 that maybe have historically done equity in the past, but now they are just essentially exploring different options out there, just and for multiple reasons. Why it can be the maturity of the company, diversification of their sources of funding. It can be something as simple as they don't want to give out any more equity anymore. I mean, there's primarily a lot of reasons why. And to your point, it just course, there's definitely going to be some outliers, right? If you go to LinkedIn, you're going to see some companies that are some of the outliers, but the vast majority of the companies are going to be facing something kind of similar to what you shared in that slide, right? So that's the main reason why Brian can bring it up. And again, Ryan, thank you so much for joining us and really appreciate that part of the conversation. So now moving into my part and just doing a quick introduction about myself. I'll do this in the meantime that I open my slides. Oscar Franco, investment manager here at Founders First. Been with the company. I'm getting closer to about my third year anniversary in here. A little bit more about me. I've been working with entrepreneurs essentially all my life through accelerators, incubators, not only here in the US, but also across Latin America. And by the way, pretty similar trends related to equity. Across Latin America as well, right? So this is not something very unique to the US. I'm definitely see some trends similar to this across Latin America. So with that, let me just open up and share this slides real quick. Just want to confirm, are you able to see my screen? Perfect. Slideshow. Perfect. So Founders First Capital Partners. First, let's kickstart on essentially why we exist and why are we here, right? So the mission behind Founders First Capital Partners is to level the playing field for companies led by underrepresented founders, right? And the way that we do it is by providing non-dilutive growth capital to growth stage companies. So again, tying my part of the presentation to what Ryan has shared, essentially means companies that are post-seed uh, found or post-seed round, Series A, or on, right? That's usually primarily the companies that we see in our pipeline, right? Led by diverse founders, primarily on the B2B sector, B2G also as well, with recurring revenue in their business model. That's usually our sweet spot, right? So a little bit more specifically on the founders that we serve, women-owned businesses, BIPOC, LGBTQIA+, veterans, um, Latinx, Asians, uh, companies doing business in low to moderate income areas, and also companies that are committed to building a diverse workforce. That's essentially primarily the founders behind the companies that we're able to partner here at Founders First. Now, getting a little bit more details on our products. Uh, Again, tying my part of the conversation to Ryan, average check size on our end, it's going to be anywhere between 400 and 1 million on that first exhibition. The companies are used all the time at a growth stage, B2B, B2G as well. Uh, the products that we can offer, revenue-based financing, that I'll get to that in a second, more traditional term loans that I'm sure maybe a lot of you guys are a little bit more familiar. And then a third product, which is a hybrid, which is a combination between revenue-based financing and term loans, right? And as far as the industry, we're industry agnostic, but primarily we focus on B2B, recurring revenue, B2G, recurring revenue type businesses, right? So getting into a little bit more detail on revenue-based financing. So for all of you that are familiar with a term loan, the easiest way to explain it is a term loan, it has a term, right? So meaning the duration of the loan and a monthly fixed payment that you have to do on a monthly basis, right? So revenue-based financing, the biggest difference is that instead of having a fixed payment on a monthly basis, there's a royalty fee percentage that the company that we calculate based on the company's net cash receipts. And that's how the companies repay their loan back, right? So, for instance, for companies that are maybe have some seasonality in the business, this is something that is, in theory, a little bit more online than what you're looking for because the payments is going to fluctuate depending on the revenue that comes in from the business, right? And again, there's multiple benefits also for exploring revenue-based financing. It's something that has been out in this industry for a while. It's not as familiar, Uh, but again, it's a great source of capital, especially for companies with a recurring revenue model, right? So some of the other benefits that I want to list real quick. Um, there's very limited financial covenants. Again, the monthly payment is going to be depending on the company's performance. So the graph on the right is essentially highlighting that. The bigger sort of the revenue of the company, sort of the bigger the payment, lower the revenue, lower the payment. Online interest, right? Essentially, our IRR will be calculated based on the company's performance. So if the company is growing uh, at a good pace on a monthly basis, you're going to be end up paying your loan a little bit sooner. No loss of control. Now, going back to essentially the biggest difference between equity and what we're doing here, there's no board seat. We have no ability to replace management. I think I've shared this at one of our previous webinars, but I'm sure Ryan, you probably know some amazing equity stories, right? Where like the perfect match, amazing founders, but there's also some other stories where maybe just doesn't go that way, right? So there's a lot of um, whether it's change of controls, change of direction in business, changing in management positions, also all those sort of stuff that usually happens through equity investing, right? So with us, you don't have to worry about that. Um, Founders retain value upon exit. So if you're a founder that is thinking about a potential exit in the next 5 to 10 years, going through debt facilities just allows you to retain as much ownership in the business as you can. So once you go to that exit, it's going to be a little bit more fruitful or rewarding for you at the end, right? And I would say just lastly, and not but not least, advice. We are able to offer sort of wraparound services for those companies that are interested in through our loans, meaning one-on-one coaching sessions, KPI reviews, growth plans, anything related to essentially the company's performance throughout the duration of our loan, we can definitely provide that service as well, right? So that is typically something that a traditional quote unquote uh, alternative lender would do, but we're able to do that here at Founders First. So a little bit more specific as far as the qualifications behind essentially revenue-based financing and term loan. The hybrid product is going to be fairly similar. So the company has to be B2B, B2G primarily, with at least 500K in annual revenues, right? The payment model, again, revenue-based financing is going to be variable. Term loans, it's going to be on a fixed payment on a monthly basis. Revenue models for both, we're looking at recurring, predictable revenue models. And by the way, the easiest way to explain this is, for example, on a more technological side, if you're a SaaS company, this is primarily what recurring revenue means, right? Whether it's monthly payments that you're collecting or annual licensing fees that are auto renew on a yearly basis, multi-year contract, that type of stuff. That's usually what we perfect for in our wheelhouse. Or on a more traditional side, maybe you're a consulting service firms and you have clients on a retainer base. That will also consider on our end sort of predictable recurring revenue as well, right? Repayment period, usually for revenue-based financing, 2 to 5 years. The term loans, we can go as short as 12 months to 5 years. Again, on the revenue-based financing, it's a little bit, of course, we model it out and try to do our best to sort of identify when the loan's going to be repaid off, but that's because the payment is variable. It might be that if the company is growing really fast, they might end up paying a little bit sooner than we expected, right? So just to keep that in mind. Available funding, we can go as low as 50 million, and we can do up to $2 million per company that we work with. And this is including follow-ons. And the easiest way to explain it is on a first exhibition, meaning on a first tranche, we can go up to 1 million, right? So let's say you're a company that is, I don't know, 10 million, 15 million, 20 million in revenue, you want 1 million, you're looking for 2 million, we can do 1 million upfront, and just based on the performance and metrics, and the company can potentially qualify for more money on our end, up to $2 million per company, right? So $2 million is our maximum facility per company. And just lastly, at the end, some of our additional requirements throughout our loans, we do require warrants, and we also require personal guarantees in all of our loans. Now, moving into, I think I already touched base a little bit on the ideal type of companies that we work with. Software as a service, SaaS products are perfect fit for our funds. Tech-enabled services, So essentially companies that are providing services using technology, again, on a B2B business model. Um, Management consulting, this is a little bit more traditional, essentially using tools to provide consulting on our end. And again, that retainer on a monthly basis is going to be what determines how predictable that revenue is. And on the non-tech, as I share, if you're a very traditional consulting firm, you could potentially also qualify, right? We just want to make sure to look at your engagement with your clients, the pricing structure you have with them, how frequent are those payments. And of course, we can take a look at it as well. As any lender, right, or any equity provider, we also have excluded industries that we don't work with. Just full transparency. The cannabis, the marijuana industry, we don't fund any companies related to that. Weapons, gambling, liquor, or nonprofits are not fit for us, right? However, if you are a company that is under one of this, and you're just looking for some funds, I don't want to put Ryan on the spot, but I mean, Ryan Redway could be a great resource for that and just try to pinpoint you in the right direction. Or as well, Founders First, we also work with some other partners and lenders that do work with this type of companies. So more than happy to make a referral to you. Now, this is just a more visual example on how a revenue-based financing loan works and how a term loan essentially works. So as I said before, we can go up to $2 million per company. That's our maximum facility. And the best way how to calculate, sort of a rule of thumb, let's put it this way, how much do you qualify for? It will be anywhere between 20 to 35 to 30%, I'll say on a maximum of the company's annual revenue. So that will be sort of our indication of what will be our sweet spot for our loan. Revenue-based financing, again, it's not a set interest rate. The monthly payment is going to be variable. And if the company already has SBA loans, bank loans, CDFI loans, those loans have favorable terms, we're more than happy to sit in a second position to them, right? That's something that we could definitely entertain, review, and have a discussion around those. Now, let's going over the example real quick. So the company is doing 1 million in revenue. They're looking for 200K. Sort of the term, and this is for RBF, right? It's going to be an estimate of 3 years. The repayment on the royalty fee is going to be anywhere between 2 to 5%. The repayment, so the total repayment obligation, it's at a 1.4x. That means that of that 200 multiplied by 1.4, 280K will be what the company is essentially obligated to repay before the expiration of the loan. And that once we hit that number on those monthly payments, then essentially the loan matures and there's no additional payment. So we're trying to hit that number, right? The 280. Now on a term loan, again, there's going to be a set interest rate. The payment is going to be fixed. And the biggest difference, as you can see, is in the payment structure, right? So instead of having that royalty fee component, there's a fixed payment on a monthly basis, right? The repayment cap is going to be the same, but just the payment is going to be different. And just lastly, I don't have the example in here, but if you want to learn more about a hybrid product, essentially what it means is a little bit of a combination of both. So there's going to be a floor payment, right? And then once the company reaches a certain level of a revenue, what we call a revenue threshold, then there's an additional kicker of a royalty fee component. That's the biggest difference. So either is purely RBF, which is variable on a monthly basis, term loan, fixed payment on a monthly basis, and then the hybrid product, which is a floor with an additional kicker once the revenue threshold is surpassed. Hopefully that makes sense. And I believe that's actually my last slide. So the next step on our end will be Ryan and myself. I know, Bobby, I saw you unmuted. More than happy to answer any questions you may have. I always find that just going through Q&A just provides a little bit more of the information that the companies are looking for. So happy to address any questions you may have.
Yeah, thank you, Oscar and Ryan. So everyone, if you do have questions, feel free to put it in the QA. But we do have one question that I can read out, and feel free, anyone that wants to take it. The one question is from Thomas. It looks like for the information presented, it looks like things are on a 4-year cycle. Does that trend hold true going back 8, 12, 16, and 20 years? I don't know that whose presentation that might have been for,
Yeah,
but
Ryan, you want to kick start with that?
Yeah, happy to take a stab at that one. So I think it may be inaccurate to say that um we or we shouldn't measure things on a 4-year cycle going back decades for a couple different reasons. One, I think what we've seen historically in equity financing has actually been a pretty sizable, not year over year, but every few years, if you measure it, certainly a lift in new equity financings, round sizes over the last couple decades have gotten larger and more frequent. Um, and if you look at this was the measurement as of about a year and a half to 2 years ago. But if you look at venture debt and private credit from a volume and total funds deployed standpoint, this segment is right around where venture was at about, give or take 10 to 12 years ago, and growing fairly aggressively. So there's a lot of factors that come into play here. If you go back, and this is me in my childhood years, and so I'll be the first to throw out the disclaimer that I'm no pro here, and I certainly was not an economist at the age of 10 years old. But if you go back to turn of the century to kind of the dot-com boom, you can obviously see a pretty big spike in terms of new fundings and originations from equity investors. And then obviously over the next couple of years, things fizzled out and kind of got back to homeostasis, if you will. And then you can see kind of an incremental, lift going through, I'd say, like the early 2010s. And then that lift kind of picked up steam headed into the later half of the decade, and I think was even further spurred on during COVID. I think COVID was kind of a big disruptor in many ways. And if you think about the companies that are raising capital, they're often innovating, they're often automating, they're making people's lives easier and more efficient. And so, notwithstanding your core kind of retail businesses that were negatively impacted during that time, if you were solving for health related items or telemedicine, things like these, obviously those companies saw a huge influx in new funding amidst the years, 2021. Additionally, grocery delivery. I mean, there's some obvious examples you can point to. And then I think just in general, a lot of the tools that might have been marginally used or might have been used in a hybrid office setting prior, where maybe you had a few select individuals using certain pieces of technology, where now all of a sudden many people are working remote and everyone needs that technology on their home laptop or desktop computer. That gave way to a lot of innovation and a lot of funding taking place. So, but back to the question, I don't think we can measure it on a 4-year basis. I mean, I think for a variety of reasons, if you zoom out, you'll see more and more funding being provided both from equity and from credit over the long term. But yeah, certainly, if you took the 4-year snapshot, you could kind of look at pre-2020 and compare that to the environment today. And there was a huge kind of you know significant lift in new fundings and decline in the interim period.
Yeah, I mean, on my end, I don't want to be repetitive. I think your explanation covers a lot of the things that I want to share. The only thing that I really want to dive a little bit deeper was on, so to your point about technology. It's sort of the way I see it is sort of tied into. I'm sure everyone's familiar with the diffusion of innovation theory, right? So depending on how essentially technology is evolving through to time, from early adopters to like the early majority, low majority, when there was legacy. the appetite for this type of companies in the venture industry, it's different, right? So going back to Ryan's point, there's I remember because I used to work with a lot of companies that were looking for equity in the past. From the dot-com era, I remember also seeing then a little bit later, sort of the e-commerce marketplaces boom. To your point, Ryan, about AI right now, which has happened 2020, 2021, health, right? So everything is tied into depending on sort of the evolution of the technology out there. And now nowadays those evolution changes on the technology happens on a more shorter period of time frame. So just something to consider as well. But I think I agree with you. Just thinking about it from a 4 year cycle, um, I think there's definitely more things that you need to consider and evaluate.
Thank you, Oscar and Ryan. I don't see any other questions. So I think we can actually probably close it out. Oh, Oscar,
Bobby,
looks like you have something.
yeah, just quickly, Ryan, I don't mean to put you on the spot, but I have a question for you. Just because we have previous experience in the as a founder, right? Raising equity, raising debt. A lot of the conversations that I have with some of the customers in our pipeline is just trying to point them in the right direction on essentially when is the right time to sort of evaluate or consider multiple options, right? So from a founder perspective, right? I know you raised debt. I know you raised equity in the past. What was your thought process behind, right? So when did you start to consider it was based on maturity? It was based on the use of funds. It was based on diversification of your funds and just make sure that you don't have everything depending on equity. Like, what was your thought process?
Yeah, it's a super fair question, and I think an important one that a lot of founding teams need to ask. The way that I look at it is through the lens of credit risk versus equity risk. Um, One has a repayment structure to it. Well, I should say this. One has a defined repayment structure to it. Equity comes with its cost, right? And often it can be a sizable cost because you're looking at a liquidity event, and the investors on the equity side are looking at a return that they hope is going to be 5x, 10x, 20x. But they're also taking a proportionate amount of risk at the onset. And so I like to keep these things in mind when you look at how the capital is being used within the business, because it's not a perfect bifurcation, but generally when I think of things like we're building and shipping new products that are not as tested as our core product and offerings that we have today, that sounds a little bit more like equity level risk. Research and development, anything that's going to take a pretty sizable headcount or team to kind of innovate and bring something new to the world. These are the types of things that I think about when I think about equity. Whereas when I think about credit, I think about certainly credit can be useful in some of the kind of 0 to 1 go-to-market strategies, but more often, I think the best and wisest use of credit is when you have something that's working in the business and that you can generally apply some sort of ROAS to, and basically say, hey, for every dollar that we're investing in X or Y, and that could be a team, that could be a product, that could be a marketing campaign. We're going to extract more value out than what we put in. And the scale is going to be something that leads to obviously revenue growth, but it's going to better bolster the bottom line of our business as well. So that's the little mental experiment that I play. I'm biased because my ventures have been lending focused. And so when I've raised a lot of equity and credit previously, there was a balance sheet component to what we were doing. And maybe there are other kind of fintech founders on this that can relate to that. So then you get into the mechanisms of, are you raising corporate debt? Are you raising debt to further invest into something else, companies, transactions? But overall, I mean, I think that's the mental math to do is what is the relative risk and reward of both the company and the underlying investment and the investor, and kind of bifurcating both. And I think, by the way, with most technology companies or tech kind of oriented, you could make a good use case at some point in the business for both a blend of some equity and some credit.
Yeah, appreciate you sharing that, Brian. And I echo essentially everything you said. Another thing that I want to mention just quickly, and I think on essentially on the priority list, I will definitely put them at the very end. I think how you frame it, it's the right approach, but also as a market validator, right? I mean, it's very different to have sort of consistently raised equity in the past, but also just showing to potential investors out there that you're also able to sustain debt as well, right? So I think that's also a great indicator that the company is moving in the right direction. Again, I would definitely put them on the very end of sort of the decision making behind it, but just something that worth considering thinking for sure.